Oh, the bloodletting has resumed. Took a little bit of a break last week on a shortened Easter holiday run in the markets. But as we begin this week back from that holiday, the risk-off train is steaming forth. This is Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive, and we're going to take a look at what might be animating these markets in the week ahead as the pain has seemingly returned. We see the markets once again under heavy pressure on a thin holiday held back Easter Monday, because of course in the US markets were open, but in Europe we have closures pretty much all around the major exchanges. Hong Kong is closed, Australia, New Zealand. So very, very thin liquidity and not a lot of conviction perhaps behind today's moves, but nevertheless a brutal tone to all of it, and for understandable reasons. We'll unpick those here momentarily, but first, let's get an anchor here in the price action that played out last week. We can see stocks back under pressure. S&P 500 down 1.5%, NASDAQ down 2.3%. That's after those blistering gains in the prior week, and in fact, those jumps there, 5.5% for the S&P, 7.2 for the NASDAQ. Those were modest versions of just how strong the prior week's rally really looked, and we'll take a look at it in just a second. But back to selling last week following those gains, and although looking just at the percentage changes here, it looks like, oh, well, we had massive rallies and then a bit of a correction, nothing to worry about. Well, it doesn't quite stack up that way when we look at the price action. Similarly, for the bond market, we had massive, massive surges in yields last 2 weeks, and the very last week, a little bit of a pullback on that. Bond markets cratering and then somewhat steadying last week after that aggressive move. And the sort of consistency in all of this still being found in gold, which posts yet another week on the upside, 2.6% after a 6.9% gain, and the dollar keeps selling off, perhaps in a parallel fashion, down another 0.5% against the euro, 0.9% against the yen. Bitcoin starting to benefit from the relentlessness of dollar selling, up 1.2%, despite the defensive tone and overall risk sentiment, as is very clearly epitomized here by the stock market. And so we have something like a pause of sorts last week, at least for the core markets. The dollar keeps limping down, gold keeps clawing its way higher, but crude oil is up as a kind of measure of cyclicality and recession risk. Yields unclench a bit, and although stocks come down, they come down after what are massive rallies, and so perhaps things aren't quite so bad. Well, not so fast, because the pain has resumed in earnest this week. Here's the S&P 500 right here, and we can see just what that massive rally was. It was a single day off 15-month lows here. Just one day where we had an announcement, 11th hour announcement to boot, from the Trump administration, the president putting out a post via his Truth Social media platform, saying that the reciprocal tariffs that he'd announced on so-called Liberation Day, when he unveiled bilateral tariff rates across most major U.S. trading partners, and in fact, almost all countries that the U.S. does business with, from Belgium to Botswana, as it were. And said that the new baseline tariff of 10% would hold, but everything above that would get put on pause for 90 days, except for China, which would not get a pause, and that this pause would give some space for perhaps the start of negotiations and some kind of a reprieve. And while the average U.S. tariff before the new minimum 10 was closer to 2, we still have a 5-fold increase in U.S. tariffs any which way you look at it. The markets looked at the episode and said, okay, we have a bit of a reprieve, a bit of a response to market discipline, because, of course, going into that announcement, that sort of softening of the on-ramp, the markets were in near free fall. So, okay, this is a little bit better. We can perhaps unclench a bit. And that lasted for all of one day. It was an explosive one day, but only one day. And of course, now we have almost fully erased that move as we get back on the defensive today. Now, the reason it lasted only one day seems pretty straightforward, and we discussed it when it occurred, essentially the day of, and put forward the idea that if the sell-off initially from about mid-February, late February, is a reflection not of the idea that there are tariffs, because that much was known back in November, and clearly no vicious sell-off materialized then. If that's not the reason, then what is? Well, it's the turn in U.S. economic data and the signs that the implementation of the tariffs is creating a situation where now you have a sense that business confidence and consumer confidence have been negatively impacted by how things are occurring, that this has put the brakes on economic activity, and that what is then following is a hit to growth, not so much because there is a tariff regime, but because of what the tariff regime is and how it is being put in place. That consumers and businesses are withholding money that they would have otherwise spent or invested around uncertainty, and that what this is doing is it's hitting the economy and creating a growth scare. And this is what the concern is. Well, if it's uncertainty that's the issue, then rolling out a schedule of tariffs and then days later pausing some of them for 90 days creates yet another cliffhanger and creates more uncertainty, which of course doesn't resolve the issue but compounds it. And so after this one-day relief jump, the markets hit a wall, tellingly at former support become resistance and settle into an easy range until the latest offense hits the tape and the markets have the chance to show their displeasure, with the president taking pot shots at Fed Chair Jerome Powell, saying his termination cannot come soon enough, bemoaning after last week's ECB rate cut that the Fed is not following suit and isn't cutting interest rates. That, of course, has spooked the markets because one of the bastions of U.S. economic credibility is the independence of Federal Reserve monetary policy making. And if the president is dictating what interest rates ought to be and what the central bank ought to do, and threatening an extrajudicial firing of the central bank head, who himself has asserted time and again that such a firing would be illegal and would be fought in court, that more uncertainty has entered into the picture. Whatever you might think of the president's opinion on interest rates, the Fed's resistance, the rules that govern the Fed's independence, whatever might be one's opinion of those things being right, wrong, or what have you, they have been a system that has served and served well, and the markets now see a threat to that architecture And that, of course, makes for more uncertainty. And that uncertainty, not surprisingly, has once again taken stocks lower. We have essentially started the return back in the direction of the lows from the beginning of the month. The pain is even more acute in the bond market, and this is now a weekly chart just to show a little bit more the overall state of things and just how critical of an inflection point we're at. Bonds stabilized a tad last week. That's after that massive sell-off that we mentioned that gave that surge in yield that we showed earlier. This was that right here. And now with this attack on the Fed, bonds are right back to those lows. They're right back to where they closed on that brutal week where the situation looked so dire. And so the question now, of course, becomes, are we essentially back at the brink? Was last week just the short pause in the process, and now the intensity of the sell-off is ready to reconstitute and the panic to move forward? Now, this perhaps is nowhere captured better than the bond market, because what the market seemed to have concluded when the president rolled out this reprieve, such as it was, on reciprocal tariffs, was that the bond market had gotten to some kind of a pain point. That what the president wants, this is ostensibly why he's berating Jerome Powell, is lower interest rates to smooth the on-ramp of all of his new policies, which would be, not surprisingly, more digestible, were money cheaper. Now, what we have as a result of these efforts is money that's more expensive. When you have this massive decline in bonds, that the flip side of that, of course, is a surge in yields. Again, that same decline in bonds corresponded with a 12.4% jump in the 10-year rate, 9.1% jump in the 2-year rate. So why is it that the actions being taken here and the uncertainty that we see in the stock market, why aren't bonds going up with that? Are they not a safe haven? Is that not what you typically see? And of course, breaking this down into the constituent components is what it takes to see exactly what's occurring. Now, in the brown here, what you have is the term premium that's embedded in 10-year nominal yields. So when we say, the 10-year yield, you can break that 10-year yield out into components. One component is term premium, which is compensation for uncertainty risk. That is the passage of time. If you think more can go wrong over the allotted time, let's say this is a 10-year rate, so if all of a sudden you think more can go wrong in that 10 years than you did before, well, then you're going to demand as a lender to be compensated more for that time, for that additional risk. And we can see that risk is surging. At the same time, the break-even inflation component of the bond yield, that is inflation expectations reflected in the Treasury market, that's falling. As if to say, yes, we do need rate cuts because all of this consternation and all of this uncertainty is going to bring on a recession that's going to be deep enough that whatever one-off hit that the tariffs engineer that pushes inflation higher is going to be offset because demand is going to be so hurt by these policies and the recession so deep that the net result for inflation will actually be lower. That what you get in terms of inflationary pressure from basically increasing consumption taxes, sales taxes as it were, on imports in a drastic way, that will be offset for the aggregate inflation rate for the country, because demand for everything will drop out of the bottom. And so this is how you end up with bond yields surging. So the upshot is that the result of all of these things has been precisely, taking the president at his word, what he doesn't want, which is to say higher borrowing costs. Now, the markets have, of course, reasoned that if a deep recession is in fact coming, then the Fed will in fact have to cut more. And we have seen that develop here over the recent weeks. As we've had stocks come off, so too the markets have baked in more easing. But we can see that the resistance from Chair Powell recently really does show up here in Fed funds futures. There hasn't been a whole lot of movement on this. We're sitting at about 115 basis points being priced in for the year. The markets in that are not so far off the Fed's own forecasting. This was the March update of the Summary of Economic Projections, where the Fed said from a base of 4.4% center line on rates, we're coming down to 3.9% this year, 3.4% next year. This is 50 basis points in cuts. This is another 50 basis points. That is to say, 100 basis points or 1% in cuts through the end of 2026. The markets are only 15 basis points more than that, so about 50-50 on a fifth cut. That's not that far off considering all of the consternation. The markets think that the cuts need to be a little bit more urgent, so they see maybe closer to 3 erring on 4 this year, maybe another one next year. But sum total, we're not so far away, a little bit more dovish than the Fed, but not so far away as to explain what's going on in bonds. And the timeline for those cuts looks very much like the Fed is going to delay until mid-year. Looking now, a full 25 basis point rate cut doesn't really get discounted until July. And then from there, we start to see more sizable consecutive hits, and the outlook starts getting a lot more dovish. Now, this is where the release valve on this consternation may very well find itself this week. There's not a whole lot of macro data on the calendar, but we do know the Fed wants to cut, and we do know the market would perhaps welcome some dovish squawking from the Fed. It certainly seems to say that the Fed has clearance to cut in what it's showing in its assessment of inflation expectations. And if the Fed were to start to talk as though it might be likelier to cut sooner, well, then perhaps some of the pressure from the White House would ease and the situation might be unwound. How likely that's to happen hinges on a couple of things this week in terms of what the markets will look for. The first will be an update of economic projections from the International Monetary Fund. The annual meetings of the fund and the World Bank are happening in Washington, D.C. at the moment. So we can see here that this is the last update from January, and the expectation is very steady from 3.2% global growth in 2024 to 3.3% the subsequent years. The advanced economies going up from 1.7 to 1.9 this year, then cooling somewhat. Very modest. The U.S. outlook, it's toward slowdown, but not a significant one, down to 2.1% in 2026, which is still quite fast by U.S. standards. China seen continuing to slow from 4.8 to 4.6 to 4.5%, but again, nothing catastrophic. But of course, this is January. So the markets will be very interested to see to what extent this is now slashed, given what's occurred and how the outlook has changed, and just how much red ink appears on this when these numbers are updated tomorrow. Next, will be the set of flash PMI numbers from S&P Global. This will be April data, and this was the beginnings of where the market started to worry about the rollout of these tariffs and other elements of the Trump administration's fiscal policy and the impact on growth. This is where the markets really got concerned. The PMI data in late February the 21st, if memory serves, is the first kind of batch that really gets things going. This is where those concerns arise. So watching how this develops going forward will be very interesting, because, of course, if you do see a very significant drop-off in the PMIs, wouldn't be a stretch to then look ahead and say, we are going to likely see this show up in the hard data that the Fed needs to see, but perhaps it will be enough to get the Fed at least talking about becoming more dovish. And then the hard data would validate, and they could get to cutting and get to walk away from this headbutting with the White House. The expectations seem to suggest that indeed a meaningful slowdown is probably on the cards. Manufacturing seems getting back into contraction mode for the U.S. As ever. These things are in a logic centered around 50, where that's neutral. Above it is growth. Below it is contraction. The faster you go, the further you go above 50, that is, the faster the growth. The further you go below 50, the faster the contraction. So this 49.4 here on manufacturing in the forecast, that speaks to contracting manufacturing in April being the baseline, and a significant slowdown in services from 54 to sub 53 expected. The numbers out of Europe don't look all that great either. The composite expected to slow there. For the UK, the same thing, back to standstill on growth there. In Japan, contraction. In Australia, contraction. So the story looks to be that of negativity. And of course, that shouldn't be much of a surprise, looking at the Atlanta Fed GDP Now model just as a barometer of where the data is going. Never mind the actual levels, whether the economy shrinks something like 1% or maybe just doesn't grow, or whether it shrinks between 2 to 3%, depending on the model here. That's less relevant than the trajectory of where things are going. And clearly they are going down. And that's the key takeaway. The data that's incoming daily to populate this model is very clearly pointing lower. In fact, Citigroup's Economic Surprise Index for the world is telling us that the generalized story here from March into April for global economic news flow is to increasingly start to deteriorate relative to forecasts. So if we get very negative results, and perhaps the Fed then starts to sound more dovish, then maybe we get a little bit of an off-ramp here, and stocks can steady and bonds can steady a bit, and perhaps even the dollar can start to come off its lows. But it is a delicate dance, and we would be hoping that the data is bad enough that the Fed relents, which is hardly something encouraging for the economy or for risk sentiment longer term. The last bit the markets can perhaps surmise is maybe there will be another policy reversal via midnight Truth Social update, and that might happen, of course, because the president seems to be increasingly unpopular. The polling here from Real Clear Politics, an average, telling us that the gap between approve and disapprove is widening increasingly to disapproval territory by about 3.6 points, it looks like, on average. And perhaps that is a forcing function for yet another reprieve of sorts. But without that, the architecture here seems to be, if only we could just get the Fed to cut with enough evidence of a deep enough recession, then maybe sentiment can unclench, but for how long? If the reciprocal tariffs example holds, then maybe we get a violent rally, but whether it holds or not is another story altogether. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I am back with Chris for Futures Power Hour Mondays and Fridays, on with Victor Jones for The Price of Truth on Tuesdays, back with Victor and Tom for First Call Sundays, writing for the News and Insights portion of tastylive.com, and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.